Welcome to Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. The Trump administration says higher tariffs will now only take effect on August the 1st, while various countries will be notified of their new rates and/or deals at 12 p.m. Eastern Time today. India says a final decision on a mini-trade deal with the United States could happen in the coming days, according to CNBC TV 18 sources. President Trump also warning countries aligning with the BRICS that they will be subject to additional tariffs. This as the group's leaders meeting in Brazil push for multilateralism as they warned of rising protectionism. Right, so the markets are currently somewhat confused now, trying to make some sense of the news flow coming out of Washington. The US flags August the 1st as a tariff deadline for some countries, so we need some clarity on that. This is while many countries are negotiating trade deals, not least of all India with the United States. So with that, let's take a look at the picture in Asian markets. They are in the main lower, with the exception of the Kospi and the Straits Times eking out some modest gains. Indian markets join us in about 45 minutes' time. Here's what Gift Nifty futures are indicating for the open. A lot is riding on arguably the next 24 to 48 hours in terms of the negotiations between India and the United States. Gift Nifty futures giving us an opening number in the region of 25,500. So that would suggest some stability, but also some caution. Dollar-rupee exchange rate at 85.469. Right, moving on. US President Trump announcing in a post on Truth Social, excuse me, in the last hour that trading partners will get tariff letters and/or deals starting today, July the 7th, 12 p.m. Eastern Time. He also had a warning for countries aligning with BRICS, quote, anti-American policies, warning that they will be subject to an additional 10% tariff rate if they did so. This as US officials have tossed a new date into the mix, August the 1st, which is when higher rates will come into effect.
I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
US Treasury Secretary Scott Bessent says there's been a lot of foot dragging in finalising trade deals, but he expects to see some big announcements in the next few days. He also told Fox News that the new August the 1st date doesn't mean there's been a pause or change in deadlines as trade negotiations continue.
I don't think it's a bit of a pause, because I think what's happened is there's a lot of congestion going into the home stretch. And as part of the trade team, what's great about having President Trump on side is he's created maximum leverage. So by telling our trading partners that they could boomerang back to the April 2nd date, I think it's really going to move things along the next couple of days and weeks.
In the meantime, the US is still working with India and on a limited scope agreement. Those talks are still going on. Our affiliate in India, CNBC TV 18, reporting that a mini trade deal could come into force in the next 24 to 48 hours. But despite the deadline approaching fast, India's Minister of Commerce, Piyush Goyal, says New Delhi is not bound by any time constraints.
India does not approve of any trade deal based on any deadline or time constraint. We will accept the deal only when it is well prepared and caters to our national interests.
Let's bring in Abhijit Das now, the author of Strategies in GATT and WTO Negotiations. He is also former Deputy Secretary of India's Commerce Department. Abhijit, thank you for your time. As you heard there earlier, our colleagues at CNBC TV 18 reporting that India and the US are expected to take a final decision on a mini trade deal within the next 24 to 48 hours. Given your experience in past cycles and past trade negotiations, do you think this has substance to it?
Thank you for having me on your program. I would conjecture that, yes, there is a possibility of India and the US sealing the deal over the next couple of days. But as with any trade negotiation, the last few hours are the toughest. The home stretch is the most difficult. But whether the trade deal will be finalized will actually depend on how pragmatic, how practical both the sides are in their eagerness to strike a deal. If hardened positions persist, then I'm afraid we might not have a deal. But if both sides see merit in some flexibility and leaving some issues to be negotiated at a later date, then we could see magic happening with most difficult issues suddenly vanishing, and we might have a trade deal. So I remain optimistic.
Understood. Abhijit, what then does that imply for the most contentious aspect of these negotiations, which is agriculture?
In agriculture, there is no doubt that the interests of the two sides are in a conflict, and that is likely to create the logjam, particularly in products such as poultry, dairy, soybean, corn, and a forgotten product, of course, is always rice. Let me start with rice. In rice, the articulation of U.S. interests through the U.S. Rice, which is the main lobby body, is very clear. They want to hit at India's minimum support price scheme for rice. Now, that will be a very, very difficult issue for India to grapple with. On the other products, as we've heard and as we've read in newspapers and other media outlet reports, US wants India to lower tariffs on dairy, poultry, and similar other products. Now, there are genuine difficulties. For example, in a product like soybean or maize, livelihoods of anywhere between 8 to 10 million farmers depend. Let's bear in mind that US products are very highly subsidized. So allowing zero duty imports into India and expecting Indian farmers to compete is absolutely unrealistic. So
Abhijit,
here, yes, please go ahead.
If I may, thank you, Abhijit. Let's just park the conversation there. I will return to you because in the meantime, I want to cross over to CNBC TV18's Parikshit Luthra, who joins us now with more details on that reporting, Parikshit, that you've been doing, and a mini trade deal between US and India, possibly imminent within the next 24 to 48 hours. Tell us more.
Well, yes, a decision now has to be taken very soon, perhaps by 9:30 p.m. or 10 p.m. India time today. We will get to know if there is indeed a deal or not. Our negotiators have returned. We've been told by sources in the Indian government that there are no further talks before the 9th of July as far as this early harvest deal or mini trade deal goes. India has drawn its red lines. We've said that we will not grant any access when it comes to sensitive areas for us in agriculture, such as wheat, rice, maize. No concessions on dairy either. Dairy is extremely important for us. Agriculture, extremely important for our farmers. What we also have to know is that U.S. farmers feed blood meal to their livestock, which as a protein supplement. And that will never go down well with the religious sensitivities in India. So there are a lot of factors related to farmers' interests, interests of different religious groups, because of which no concession would be granted. Having said that, India says that they have proposed a very fair deal, which would give good access to India's labor-intensive sectors, such as MSMEs, SMEs for footwear, textiles. There could be a quota system implemented by the US for India's labor-intensive goods. On auto tariffs, we're told India has offered similar concessions as what has been offered to the UK, for that matter, or the European Union. Let's see what happens over the next few hours. And we've also seen how Donald Trump has said that any country aligning with anti-America policies of the BRICS will face additional tariffs. Prime Minister Modi went for the BRICS summit. Xi Jinping and Putin did not go. Let's see what happens.
Parikshit, thank you very much indeed for that. Abhijit, I'm sure you were listening into that. And in the past, India has not budged on the issue of opening up the agriculture and the dairy sectors. Is it going to be any different this time?
You're very right that even in a deal with Australia, which has strong interests in dairy, India did not budge. The dynamics with US might be slightly different. If I understand the US position correctly, they are not interested in exporting liquid milk to India. Their interests might perhaps be in high-end cheese or cheese which is used in the American pizzas sold in the Indian market. And that is one area that is high-end cheese where India could consider granting concessions without having adverse impact on its domestic producers. In some of the other products, maybe a system of tariff rate quota could be implemented, provided that the quantity which India might allow US to export at lower tariffs might not be very large. But that has to be accompanied with some restrictions on prices. As I mentioned earlier, given the fact that US agriculture production and exports is highly subsidized, India might be in a mood to give a tariff rate quota, provided the price of the imported product doesn't fall below a particular floor. So these could be viable ways of making progress in the negotiations.
Understood. So India may be prepared to offer limited access through tariff cuts and quotas on some select agricultural products. But there are some other contentious sticking points as well, aren't there, Abhijit? Not least of all, auto components and steel. How are the negotiators going to get round those areas?
Certainly, these two areas of auto and steel are highly contentious. I would think that auto perhaps is more problematic, given the fact that the auto industry in India contributes almost 50% of the manufacturing value added. So I don't see a possibility whereby India opens up its automobile market for the US exports. What might happen, as Parikshit said earlier, is that India might consider very small quantities within which it might allow imports from US. But again, these quotas would have to be for high-end automobiles, certainly not for smaller and mid-range cars. That I don't think is likely to happen.
Do you think that conversation is going to be even more challenging, given that barely 2 days ago India proposed retaliatory tariffs, retaliatory duties at the WTO against US tariffs on vehicles?
Let's bear in mind that what India has done at the WTO is to preserve its rights to retaliate against the US, both in steel and auto sector in the future. It is not an automatic process whereby India will retaliate. Under the WTO rules, there are very clearly specified deadlines. If you miss those deadlines, then you cannot retaliate. So India has merely preserved its right to retaliate, and I think this should enhance India's leverage in the WTO negotiations with US.
There's clearly a lot of hard bargaining going on, Abhijit, and India clearly has marked itself out as no pushover. In fact, the negotiators have laid down these red lines surrounding agriculture. Piyush Goyal has said that they will not be swayed by deadline-driven diktats, and the national interest will be paramount. Is there a risk that both sides could just call it quits and walk away from the negotiating table, for now at least?
If the two sides continue with their entrenched positions, with their deep red lines and show little flexibility, then yes, that risk certainly is there. But overall, I think the two sides are pragmatic. They may want to show flexibility. And let's also bear in mind that President Trump would be very keen to announce a deal. So that might compel both the countries to move ahead in a spirit of cooperation and optimism that a deal would be possible. So if I were a betting person, I would say that possibility of a deal may be higher than the two sides walking off the negotiating table.
Abhijit, how big a game spoiler could non-tariff barriers like India's quality control orders, QCO. Is that going to be, or how much of an obstacle is that to US market access, and to what degree is that going to figure in these talks?
You're very right that the QCOs would have figured in the talks. But at the same time, if we go back to the statement made by the Commerce Minister Piyush Goyal a few weeks ago, where he said that the developed countries are really not the problem when it comes to compliance with the QCOs. So my assessment is that India will find ways whereby exceptions could be crafted for the US to allow so that the QCOs do not become a barrier. But at the same time, there's another non-tariff issue which is highly pertinent and highly controversial that relates to the GM products. US is very, very keen to export GM corn or GM soya to India. India is absolutely reluctant to allow those imports. So there the landing zone could be that while India does not grant immediate access to US GM agri products, India might give an assurance that it will put in place a regulatory mechanism which has more predictability, more certainty in terms of timeframes. That could be something which would protect India's interests as well as give some assurance to the US on GM products.
Abhijit, I'm glad you referred to landing zones. Where else could we see some traction, some progress and commitments from India to buy more US LNG, energy, nuclear reactors, SMRs, defence? How big is that going to figure in a potential deal?
Those would certainly be very, very important elements in a potential deal. But there, the key points to what is, at what price, under what terms and conditions would India agree to armament purchases or purchases of energy products. Let's also be very clear. The reason why India is at the negotiating table at this juncture with US is that about 17 to 18% of its exports go to US. We need to make sure that India's reliance on US for its exports does not increase further. India has to make sure that its exports get further diversified in terms of markets. And while it should be able to give some satisfaction to the US in energy products or defense purchases, the terms and conditions and the pricing has to be right.
So notwithstanding, Abhijit, this commentary from Scott Bessent about boomeranging back to the April the second tariff levels, do you think that the baseline of 10% will remain on India in terms of a best case scenario? And ultimately, do you think that there is a pathway for a final deal by October, the proverbial deal by Diwali?
Yes, the final deal by September or October should make sure that US tariffs, particularly on labor-intensive exports of India, textile and clothing, leather, maybe some gems and jewelry sector, those come below the WTO mandated most favored nation tariffs. I would think that it would be not a good deal if India continues to face the 10% reciprocal tariffs. So India's endeavor has to be make sure that not only does India escape from having to pay the 26% tariffs, in addition, it must get additional market access by US lowering its MFN tariffs. Let's bear in mind that India would be lowering its MFN tariffs for US. So it's just fair that there is reciprocity from the US side as well.
Abhijit, thank you for that. It looks like negotiators are prepared to kick the can down the road in terms of some of the most challenging aspects that are bedeviling a US-India bilateral trade agreement. We thank you, Abhijit, for that analysis. Abhijit Das, there, author of Strategies in GATT and WTO Negotiations. Right, in the meantime, Japan is also not willing to back down in trade negotiations with the United States. Lin joins us now with the latest on that front. Good to see you, Lin.
Yeah, good to see you. Japan remaining defiant as that clock is ticking. We had heard some chatter that Ryosei Akazawa was supposed to go to Washington at the weekend. That didn't eventuate. Instead, he had two quote-unquote in-depth conversations with Howard Lutnick, one for 45 minutes, another for 60 minutes as well. Meanwhile, as of course the campaign for the election ramps up, we've been hearing a lot from the Prime Minister Ishiba. He did give an interview on national television yesterday where basically reasserting that Japan will not give up its position easily, will not compromise easily, and even allies have to say what they have to say as well. Now, in terms of the analyst view here, there is this feeling that Ishiba is in a difficult position because on the one hand, ahead of the elections, he needs to remain tough, they say, because, you know, he doesn't want to seem like he's been weak and get a deal that's ultimately a bad deal. But on the other hand as well, we did hear that the US president has been threatening, floating out there these higher tariff rates for Japan as well. Let's listen to what one analyst had to say, Fred Newman from HSBC.
Obviously, the complication is for Japanese negotiators that you're facing an election. And so in the run-up to that, even more so, you need to kind of hold the line, which you want to do anyways to protect your economy. What you might find is that after July 20th, maybe that kind of unlocks a little bit the negotiations. We might get a deal over the line. Big sticking point, of course, remains cars.
Indeed, cars remains a sticking point. Also, rice. I was hearing your conversation earlier that's also, of course, a major point in terms of India and US talks as well. And certainly, when you look at the market reaction, we've got about 0.5% fall for the Nikkei 225 today, and less than 1% yet last week, despite the barrage of criticism that has come from the US president. So there's an argument to be made that the market has not been pricing in that worst-case scenario of a higher rate than that snapback rate of 24% for Japan, Sri.
Exactly. So it seems to be a consistent theme. Get the low-hanging fruit, get a deal, an interim deal, a mini deal, and then do the harder stuff later on down the line. Lynn, thank you very much indeed for that. Southeast Asia, other countries will be trying to follow Vietnam's footsteps in concluding some form of a deal with the US. JP has been tracking that and joins us now.
Yeah, Sri, and you know, it's not over until the final whistle, as some people in the world of sports would say. And, you know, even though the July 9 deadline is fast approaching, we have countries like Indonesia that are still sending negotiators to Washington, D.C. to hammer out a trade deal as recently as today. In fact, their senior economics minister, Erlangga Hartarto, who is currently in Brazil with Prabowo Subianto, the president of Indonesia, on the sidelines of the BRICS summit. He is now heading to Washington, D.C. to hold last-minute trade talks with the United States to see if they can clinch a better deal. Now, we have to remember Indonesia offered $34 billion additional U.S. goods purchases to try and improve the trade balance leading up to the imposition of this trade deal. And they're one of a number of countries, including Thailand and Cambodia, that have ramped up talks with the U.S. to try and achieve a way to lower these potential tariffs that could be as high as 36% for Thailand, for instance. Now, we have to remember Vietnam is the only one so far that's clinched a definitive trade deal with the U.S. that will see their tariffs fall from a proposed 46% to just 20%. But the key thing here, Sri, is that there is that 40% tariff on goods that have been deemed transshipped through Vietnam to avoid tariffs, especially those coming from China. This is something that the Thai finance minister, Pichai Srinivajaya, actually mentioned when he came back from those trade talks with the U.S. on July 4. He said that Thailand will now ramp up its crackdown on possible transshipped goods that are being funneled through Thailand towards the United States in an effort to try and improve relations and get to a trade deal with the United States. Whether or not it's enough, it remains to be seen. But remember, the clock is indeed ticking, and countries like Indonesia are wasting no time to try to get as much done before that July deadline. Sri, is back to you.
JP, excellent. Thank you very much indeed for that. Coming up on the programme, President Trump threatening tariffs on countries aligning with the BRICS as the bloc tries to unite against US tariffs. We will discuss the constantly evolving lines there and the impact on India. That's coming up after this short break. Stay with us. Welcome back. Oil prices are down over 1% after OPEC Plus ramped up its output hike over the weekend. Producer group deciding to raise production by a more than expected 548,000 barrels a day in August. That's up from its 411,000 barrel hike in the last 3 months. It still sees, rather curiously, healthy market fundamentals with inventories on the low side and a steady global economic outlook. Following the meeting, Saudi Arabia raised its selling price for Asian customers to its highest in 4 months. And the Indian rupee is one of the currencies that moves sharply on volatility in oil prices. This is how it's looking right now. Dollar rupee exchange rate at 85.57 on the nose. And futures, as we count down to the market open, doing this. The market's got one eye on the evolution of the US-India trade deal. And as our colleagues at TV18 have been reporting, we could see an interim mini deal in the next 24, 48 hours, although agriculture, as we've been saying, remains a big sticking point. Gift Nifty futures suggesting an opening number in the region of 25,500, so a little change from where we left off on Friday. Moving on to the 2025 BRICS summit. The leaders of the BRICS group are in Brazil for the annual meeting. The bloc condemned the violence in Iran, Gaza and the terrorist attacks in India's Kashmir. Indian Prime Minister Narendra Modi is also at the event and asked for no hesitation in imposing sanctions against terrorists. BRICS also warned about the impact of an indiscriminate rise in US tariffs without directly naming Washington. The bloc called for increasing the use of local currency in trade to improve the clout of the global south, pushing for multilateral diplomacy. But US President Trump took to his Truth Social in the last hour, and Trump threatening another 10% tariff on countries aligning with the BRICS, quote, anti-American policies. Let's talk more about this and the issues surrounding de-dollarization. Claudio Piron is joining us now, head of Asia FX rates and strategy at Bank of America Global Research. Claudio, great to have you on the programme. I mean, optically, given how the US-India talks are at such a crucial stage, New Delhi can't do anything that is really consistent with rocking the boat in terms of de-dollarization, can it?
No, and I think so far the communications and the signalling both from the White House and from New Delhi have been quite positive. I think they're both very interested and engaged in getting a deal over the line. So I think amongst all the countries that are in the negotiations at the moment, they're in the envious spot of being in a good relationship. So I think no, and there's no need necessarily to rock the boat.
If there is a deal, and our colleagues at TV18 have been saying there could be a mini deal in the next 24 to 48 hours, then is that in the price, in the exchange rate?
Not entirely. I think INR, the Indian rupee, has been lagging a little bit behind, and on that tweet headline it kind of softened marginally. So I think we could definitely trade stronger. If you look at some of the fundamentals that India has been achieving, best current account in over 18 months, very solid deficit of the current account, less than 1%, FX reserves back to 700 billion, inflation at 2.2%. What is there not to like? Yet the currency's kind of underperformed. So I think we could see a move nicely to 84 over the next coming months, assuming the whole world is moving in the right direction.
And getting back to this de-dollarization issue, we're well aware of how China has been promoting bilateral trade settlements in yuan. What evidence is there that India is developing its own payment system to perhaps bypass traditional mechanisms like SWIFT and reduce dependency on the dollar?
I think it's very, very limited at the margin. And I think really, I mean, both you and I have been in Asia for a long time. So I think the way to look at it in the broader sweep of things is not necessarily de-dollarization, but normalization. So what do we mean by normalization? The posture of a lot of Asian countries, India included, which had the balance of payments crisis in '91 and so forth, was always to be very defensive about capital inflows and always to be very, very concerned that they don't want a financial crisis. And then we had the Asian financial crises. I think we're starting to drop that, partly because we've matured. We've got higher levels of FX reserves in the region. We've got good local domestic bond markets, which means that there's less dependency on foreign borrowing, which means that people can actually relax a little bit about capital flows. So we've had the index inclusion for India, for the bond market. And I think the other kind of disappointing thing has been the development of non-deliverable forward markets, offshore markets, that are often doing more of the foreign exchange business in London and other centres around the world. So there's a greater shift towards why aren't we getting more of this FX business onshore? And finally, why aren't we doing more cross-border settlement, which is only natural because intra-regional trade is picking up and becoming more and more substantive. So I see it in that context as being more of a normalization in the posture rather than being a posture towards being aggressively towards de-dollarization. And I don't think, particularly in the current climate, that would be in the interest and the view of Indian policymakers.
Exactly. At a central bank level, are RBI reserves telling you that there is a gradual shift, normalization as you characterize it, away from the US dollar? Or is it telling us a different story?
Yeah. So I think broadly speaking, I mean, there's a lot of excitement, and understandably so, about de-dollarization and so forth. I get it. But we don't even need to get there. We can just talk about the valuation currently of the US dollar, which does look overvalued by many fundamental values if you're looking at the current account position. You could look at it from a policy perspective from the United States, that they would like to see a softer dollar in terms of export competitiveness and so forth. So I think we can see that cyclical adjustment without even having to go into that whole de-dollarization debate. So I think that's something that will evolve going forward.
So that shift, the shift that we are seeing away from the dollar is cyclical as opposed to structural? Because it's important to distinguish between dollar depreciation and de-dollarization.
Okay, so coming back to your question, which is about the central banks, I think clearly when we look at some of the official statistics of the IMF, we've seen that dollar allocation come lower. We've seen, at the margin, diversification. So we've seen, obviously, good inflows into markets around the region with investment-grade Korean bonds, Singapore bonds, and so forth. You can see it in the price action in the market. You can see it in gold, and you could even argue more on a private balance sheet, household, corporate level, some movement into the crypto asset scene. But these are all very marginal diversifications. It's still very difficult to get away from the US Treasury market. And again, I think if you look at the broader sweep of over 150 years or more of US Treasury yields, we're more or less around the long-term average of US yields. So you could argue within those 150 years or so of yield performance, the US has seen a lot. So you're getting at an average level still. So I think there's still a fundamental attraction in not just the safe haven allocation, but in terms of the valuation of US yields currently.
When we're having this conversation, we've got to look at this through the lens of the commodity markets, and we all are familiar with the petro yuan. What about the petro rupee? And where is India, which is the world's third largest oil importer, in terms of internationalizing the rupee for oil payments?
Yeah. See, here we're coming back to that, that debate. This is I would characterize as normalization. You're a country, you import a lot of a commodity, and then your concern is FX risk. And in particular, you could think of a country like India, which still has a large amount of SMEs, small, medium-sized enterprises, that find it difficult maybe to hedge in the oil market and so forth. So being able to invoice and make payments in India rupee would actually be beneficial for some of these corporates and companies and so forth. So again, I think that would be a normal interest. It doesn't necessarily have anything to do with saying, we're wishing to weaponize and so forth. It's just a natural progression in terms of we are a large importer, we have a degree of economic interest and also a degree of economic purchasing power, and we would like to buy that in Indian rupee, and maybe the oil supplier on the other side can take care of the FX risk instead.
Broadly speaking, do you think BRICS collectively have a strategy to upstage the dollar and its reserve status, or am I being a bit too conspiratorial about this?
I mean, obviously, we're in uncharted waters, but, when you come down just to classic things such as the economic heft and size, yes, China is the second largest economy in the world, but when you look at the tail of that BRICS, it really diminishes. And then, the operative word of the day is multipolar world, which sounds very fancy, but ultimately it means sovereign self-interest. And it makes it harder, really, to build these coalitions. So I think we even see it with India. India started to distance itself a little bit in terms of doing the trade deals with ASEAN. So saying, hey, I've got to prioritize my relationship with the United States first. So it's all about, it's nothing personal, it's business, it's sovereign self-interest, and this is the current situation where we're in. There are attempts, naturally, to provide some structure, and that will evolve, I think, as we're going forward. And we're seeing that. BRICS is one attempt. We're seeing other attempts globally to try to establish some kind of new rules of the road. And that will, I guess, mature over time. And we just have to see how that evolves over time.
At a time when the emphasis seems to be on getting your fiscal house in order, or maintaining your fiscal house and not overspending, and we saw how gilts market beat up the UK recently, and we saw that with we're starting to see that with the US, and we could see more of that volatility with the US dollar in the bond markets because of the taxation plans. Is India something of a beacon when you consider that the focus that it has been putting on fiscal discipline?
Well, I think you could see that, broadly speaking, in a lot of Asian markets. And I was just speaking, with some of our
it almost seems to be that the shoe is on the other foot, right?
To some degree, yes. I mean, again, we are still dealing with, the the trillion-dollar gorilla in the room, which is the US bond market and credit market and so forth. But if you look at Asian credits, credit spreads as well, not just in Asian emerging markets, are trading so tight, at record tight levels. And allocation is still coming into these markets. And cash levels are still relatively high. And the positioning is still, you could argue, neutral in terms of allocation, particularly amongst EM funds. So I think we're going to see more of this, what you characterize sometimes as a pejorative term, tourists who are coming over from credit markets and other markets into emerging markets. But we, tongue-in-cheek, say they're now applying for residency and saying, okay, we want a longer-term allocation into the emerging markets because the fundamentals are looking better. And we are moving away from a narrative of let's go for growth and invest in growth. But the narrative is moving towards, let's think about capital preservation. And capital preservation, another word for it is valuation. You know, value stocks, value bonds used to be a dirty word. Everybody wanted growth, but I think now that's being leveled up a bit.
Yes, and even though that valuation issue that many had with the Indian equity market is now looking justified. Claudio, we'll leave it there. Thank you very much indeed for joining me on Inside India. Claudio Piron there from Bank of America Global Research. Right. We're counting down to the market open in Mumbai. We're back in 2 minutes with an update there. Welcome back. Before we get to the market open, let's talk shoes and copyright. Birkenstock is cracking down on its made in India copies. The German footwear maker filed an infringement case and showed copied designs to the court. Legal representatives then visited factories of these small-scale manufacturers. US-based Crocs also recently secured approval to pursue a similar infringement case that it started 9 years ago. And let's bring you to the Indian markets, which are just joining the trading day. Here's the action on the Nifty 50, the benchmark at 25,440. So some caution creeping in, which is understandable, given the fact that we are still waiting for some details on a possible mini deal or an interim deal, depending on how you characterize it, between the US and India trade deal. That could materialise, according to our colleagues at CNBC TV 18, within the next 24 to 48 hours. So the market primed for that. Dollar-rupee exchange rate at 85.6375. Market still gauging the impact too, from SEBI's ban on Jane Street, the Indian market regulator widening its probe into the US trading firm. The investigation will now include other exchanges and indexes apart from those on the National Stock Exchange, where SEBI alleged market manipulation by Jane Street and froze over $500,000. However, the regulator there says there aren't any ongoing investigations of a similar scale as of now. Over the weekend, the chairman of SEBI, Tuhin Kantapandi, reiterated that the regulator will not tolerate market manipulation. Speaking at an event, he added that SEBI has strengthened its surveillance mechanisms. Let's talk about this and get into the broader market outlook and bring in Anish Mathew now, CEO and CIO at Sundaram Asset Management. Singapore joins me now. Anish, great to have you on Inside India and welcome. Let's start with this action by SEBI. Is this a one-off or does it herald a wider, deeper crackdown on high-frequency trading?
Thanks, Sri, for having me here. See, this is all part of the market evolution. When you have regulations put in place, there will be loopholes, and smart money will obviously manipulate these loopholes to their benefit. And then the regulator, after some time, will step in and clean up the act. And that is what I feel is happening. So this is all part and parcel of the evolution of the market. There may be others who may have similarly done manipulations. But by and large, this is a process which all markets go through, and it'll get cleaned up. The more important fact here, why the regulator stepped in is because of the retails, consistently losing money in the derivative markets. Post the COVID, we saw a lot of retail participation in the derivative markets. If you look at the numbers, there's something like 1 million retail investors participating in the derivative markets currently. And by some study done by SEBI, they lost something like $21 billion in the last 3 years. So obviously the regulator is stepping in, taking a closer look and closing out all the loopholes which have been in place.
It's often challenging, isn't it, from a regulatory point of view, because you want to let the market work, but you don't want to encourage excesses. Do you think that SEBI has struck the right balance here? And is this a positive signal from the regulator in terms of the ensuring of a transparent and an ethical marketplace in the longer term?
Definitely, because the regulator has to look out for everybody, and particularly the small investors. So definitely this is a positive move by SEBI, in my view.
Right. Right. In fact, in terms of the broader market sentiment, the fixation now is on the trade deal. Our colleagues at TV18 are reporting that this could be imminent in the next 24 to 48 hours. If it is a mini deal, if the low-hanging fruit is dealt with first, and if the tougher stuff, including agriculture, is kicked down the road to perhaps October, is that a scenario and outcome that the market will respond positively to?
I think the market is already pricing that in, if you ask me, because if you're to take a step back and look at how important is a trade deal for India. If you look at exports to US, that is something like 2.3% of India's GDP. So it is not a big thing. And if you look at the monthly trade deficit that India is running with the US, that is something like 12 billion US dollars compared to if you look at China, that's about 68 billion, or if you look at EU, that's about 60 billion. So from an India perspective, this deal in itself is not a make or break deal. Yes, it is important to have a big wide economy like US being a part of the deal, but it is not a make or break deal from an Indian perspective. And the market is, I think, taking all this in its own stride.
How then should the playbook for the new fiscal quarter and allocation look like?
If you look at the Indian market, my own view is it's going through a phase of consolidation. Valuations are no doubt expensive. If you look at forward earnings, the market is trading at 22, 23 times earnings. Why it is not coming down is because, you have seen such strong inflows from the domestic investors. If you look at the numbers for the first half of this current calendar year, domestics have bought something like $41 billion pumped it into the equity markets, when foreigners have net sold something like $11 billion. And this is a structural change which is happening in India, because if you look at interest rates, historically, they have always been close to double digits. Now, because inflation has come under control, interest rates are coming down structurally. And as a result, money is moving from the deposits into the equity market. And as you know, India, from a demographic point of view, has a very young population. So as people, get into the workforce, start to earn, they will, put more and more money into the equity market. So this is, in reality, you would have seen a correction in the Indian market, because it's kind of, if you look at the earnings growth, earnings growth is running at, if you look at Nifty 50, in the last 3-4 quarters, it's been running at only high single digits, back down from the 20% we saw from FY20 to 24. So in reality, you would have seen a much deeper correction, but that correction is not happening because, you have the domestic investors putting money into the market. So it's going through a consolidation phase where I think, it'll move sideways till the earnings catch up. On the positive side, if you look at it, you have, from June of last year, you saw the earnings slow down. So the base effect will start to kick in. And then you've seen the government take a lot of positive policy measures.
Yes.
So that's, so if you look at the outlook 12 months down the road, you'll see the earnings growth start to pick up meaningfully. And then probably markets after consolidation will move up.
In this environment, Anish, if domestic DIIs are in the driver's seat, we want to be owners of the banks, we want to be owners of FMCG, notwithstanding and despite the uncertainty on the international stage and the uncertainty surrounding tariffs.
Yes, consumption, in my view, should be the number one sector from an investment perspective. This is because the policy measures, you've seen the RBI, put in tons of liquidity into the market, cut back interest rates aggressively. You've seen the government, bring down income tax slabs in the budget, which went by. And what is coming forth next year in the beginning is the, pay commission, the 8th pay commission, which is going to increase the salaries of the central government employees and eventually percolate down to the PSU employees and the state government employees. That in itself, in our view, will add something like a 1% GDP boost. So consumption, historically, if you look at the pay commission and the post-pay commission impact, consumption has always benefited. 2 4-wheeler sales, consumer durable sales, even buying of gold, residential properties. These have typically, done well, post the pay commission. So consumption is the number one sector. Then, as you rightly mentioned, the financial sector should do well. In the interim, you're seeing net interest margin pressures because you're seeing the loans repriced down faster than the deposits. But that will, change tack in a couple of quarters' time. And you see NIMs, bounce back, and then you see the credit growth pick up because of lower interest rates and the liquidity environment improving. And then, obviously, the NPA situation is under control. So the financial sector will do well. And within financials, particularly the wealth managers, because as India is growing richer, the wealth is increasing. So that is one segment which will really come into play.
Very quickly, we have about 1.5 minutes left, Anish. Do you like the IPO story? Because I recall HDB, there were some issues surrounding what many saw as a valuation mismatch and a lot of these IPOs being priced perhaps too aggressively. How do we navigate our way around that one?
Yes, it is hit and miss when you look at the unlisted market, the pricing which happens in the unlisted market and the pricing at which, the IPO takes place. If you look at the recent examples, most of the pricing in the IPO is lower than what is there in the unlisted market. So definitely, if you are investing in the unlisted market, there's a risk involved. But, once the IPO takes place, it's a fair, pricing mechanism. It's out there in the open and investors, have the ability to come and buy or sell. And particularly, once the lockup period gets over, then you have a really, free market.
Anish, we've got to wrap it up there. So always great talking to you. Thank you very much indeed for joining me on Inside India. Anish Matthew there from Sundaram Asset Management, Singapore. Right, on that note, that's all the time that we have on this Monday edition of Inside India. Do keep watching CNBC. Access Middle East is coming up next.